welcome to section two, which is called money management and taking profit. This is not a topic that a lot of people like to discuss and learn, so I would just make it very concise and as easy as possible to understand. So to get everything started, when you first start trading, you will be trading with a paper account, which means that it is fake money. So you can learn how to be consistent and spot the pattern on a daily basis. However, once you are ready to fund your actual account with real money, you can start off the account with $500 or $700, but I recommend starting an account with $1,000. Once you start the account with $1,000, you will not take a position any bigger than one lot. Later down the course, I will show you what one lot means and how to um, break them down in stack orders and what stacking orders means. But for the sake of the money management topic, I would just break it down as much as I can to make it easy to understand. So for every $1,000 in your account, you would only use one lot max. And also one lot is the equivalent of $10 per pip. All right, you might be asking, what is a pip? A pip is the smallest move in incremental price on a chart. For example, from 1770 to 1760, there is 10 pips right here, which we're going by the fourth decimal. And from 1760 to 1750, there's another 10 pips, 1750, 1740, another 10 pips, and so forth. So one lot on a 10 pip scalp will give you $100. So that is where we're gonna begin when it comes to doubling your account in this journey. So on $1,000 account, you will take 2.50 positions, which is the equivalent of one lot. The reason why you will break it down into 0.50 positions and not just one lot is because you want flexibility on your entry. Let's say, for example, that you want to take a short here. You're not sure if it's going to spike up a little higher, so you might want to short 0.50 right here. And once it flushes and it goes in your favor and then it has a small pullback, you can go in another 0.50. And then you're maxed out at this point. You're in one lot. And then you just let the flush happen. And at 10 pips, you can take profit on a 0.50 position, which is $50, and let the other 0.50 position just run. And that's the way how you can increase your profit from $100 to possibly $200 or $300. Just for the simple fact that if you go in a short at this point with one lot, you could only take profit once. And if you take profit here, you might be up $100. However, you're missing this entire drawdown. So it's good to add position as the trade is occurring, but it's also good to pay yourself as the trade is playing out, which is part of the teachings that I will be explaining here in Fibs Don't Lie course. All right, so getting back to the point here, you will start an account with $1,000. You will not take any position bigger than one lot, and I recommend two positions of 0.50 lots. You will take profit at 10 pips automatically. It is mandatory for you to pay yourself immediately after a 10 pip move on your favor, for the simple fact that you're starting off with a very relatively small account and a very small position size that doesn't really give you enough profit. And starting off with your account is the most challenging part of trading. Once you get to a comfortable size, like $2,000 or $3,000, and anything bigger than that, you have more flexibility. So it's just in the beginning phase that you want to pay yourself after the move has gone in your favor for 10 pips and immediately pay yourself. If it goes against you for 10 pips, you will cut the trade short and just you will lose no more than $100. And you will continue to do this until you grow your account to $2,000. Once you grow the account to $2,000, you will not trade with any more than 2 lots or 4 positions of 0.50 lots. I would personally recommend you to take 4 different positions of 0.50 lots instead of just 2 big positions of 1 lot, just for the simple sake of accuracy. Accuracy is not always going to be perfect. It's never going to be perfect when it comes to trading. So you want to start averaging in on your position. So again, with this example, if you were going to short here, you would short 0.50, then you short again another 0.50. You're already in 50% of your position is going in your favor. It has a small pullback. Then here you can add another 0.50 and then add another 0.50. And as it goes in your favor at 10 pips, you can take 1 lot of the trade and let another 1 lot run. And that way you can compound your winners a lot faster. So if you notice, once you make it to $2,000 on your account, you will no longer just take 10 pip trades. You will be taking profit at 10 pips and letting positions run down to 20, 30, or even 40 pips, depending on your tolerance. All right, once you make it to $3,000 on your account, you will immediately withdraw your initial capital, which was $1,000 that you used to fund the account. And the reason why I mention this is because once you remove the danger of risking your hard-earned money, and then you're just trading with house money, as they call it, whenever you're just trading with profit, it makes things smoother and less emotional. So once you pay yourself back to your account, your personal account, the $1,000, and you can just trade with profits, you will start back with $2,000. And at this point, you will go back to trading with 2 lots, and you will be taking 4 positions of 0.50 lots, as I mentioned. When you get close to the $3,000 margin, you can increase to 3 lots, but I wouldn't recommend it unless your accuracy is at least 85%, which means that you're taking winning positions at least 85% of the time, which is difficult to obtain if you're a beginner trader. I'm not sure how much experience you guys might have, but it is a bit difficult to have an 85% accuracy or above. So I would suggest staying within the 2 lot parameter for the $2,000 or below $3,000 account. And after you withdraw your $1,000 and you build up your $2,000 account back to 3,000, and you go to trading 3 lots with the $3,000 up until you get to $4,000. At $4,000, you would increase your position to 4 lots or two lot positions. I would personally recommend taking 4 1 lot positions, like I mentioned, for the sake of taking profit and covering your profit and cutting your risk off the table as soon as possible. So once you go into a trade here, for example, the same example, if you take a short here and you take a short 1 lot position, then you take another short 1 lot position, it fluctuates, pull back, another 2 lot position, and another 1 lot short position, and another 1 lot short position. At 10 pips, you can take profit on 1 lot, let it ride, take profit on another lot, take profit on another lot, and take profit on another lot. So this way you're just increasing your profit margin at this point. And so forth. You would do this with $5,000, six, seven, eight, nine, $10,000. However, on your journey from $4,000 to $10,000, you will not increase your position from 4 lots max. This is where overconfidence plays a big role. And someone sees that they started with a $1,000 account, they already pay themselves at 3,000. They're already up $5,000 or $6,000, so they think they are knowledgeable enough, they think they're that good of a trader that they can just start trading with 5 lots because they have $5,000, or 6 lots because they have $6,000. It does not work that way, because at this way you're just at this rate, or at this stage, you're just learning how to be a consistent trader. It's not about the money. It is about being consistent and growing your account in small increments. There is ways with my strategy that you can definitely grow your account substantially in just a matter of a month. I personally, I opened an account with $500 a few months ago to see how much I can grow it, and I grew it to $6,500 in 30 days. So when I tell you that this is possible, this is possible. However, life is not perfect and you will experience drawdowns. So for that reason, I wouldn't want you to trade with more than 4 lots until you make it up to $10,000. And once you make it up to $10,000, you need to come up with a plan on how you're going to pay yourself. I personally like to pay myself every week. Every Friday, pull out money from your account. Or every 2 weeks, you can pay yourself. I personally know traders that they pay themselves every month. It is okay. It is just better to take profits the sooner the better, because you're limiting your exposure on the market. If you're already up, for example, $6,000 or $7,000, I will recommend paying yourself at least $2,000 more, 2,000 more dollars than your initial $1,000 that you pulled out from your initial investment, just to pay yourself. As you pay yourself, you don't see yourself getting hurt if something bad happens when you're trading. If you forget to place a stop loss, or if you have a string of losers back to back and you're down $500 or $600, you already paid yourself, so you don't feel that bad about it, and your confidence level is not going to diminish. So this is part of you just growing a healthy confidence level on your trading, and being able to also grow your account. So I know this is a lot of information to intake at once. Just try to write this down. And once we're done with this entire course, I will show you how to apply this theory or strategy with a paper account. And once you can do this with a paper account, you will definitely be able to do it with your real account with real money.